For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and implied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockeinyoursuccess.com/memberships.
Hello, everyone, and welcome to our Market Outlook Open House. I'd like to make a special welcome to our special guests that we're having who are attending a free session of the Market Outlook. Just a little bit about Market Outlook is a lot of people believe that when we talk about analyzing the market, we need to know exactly where the price is going over the next, 3 hours or the next day or so forth. And that's not really what it's about. Market Outlook is about understanding the playing field in which you're playing. It's kind of like if you're going to go to football, a lot of people try to trade the market as if, if you're going to compare it to a football game, I'm going to go out and we're going to run the same play regardless of what the score is, regardless of the team that we're playing, regardless of where we're playing, regardless of when we're playing. And any football coach would tell you that that would be a foolish thing to do. And to an extent, it's also a foolish thing to do within the market, to have a set of trading rules and blindly follow them and hope they win just because they've won in the past is, it's a beginner's way of looking at the marketplace. A professional trader wants to understand, and it's going to be extremely beneficial to understand the context in which the market you're trading. And if you understand the context in which the market you're trading, and you understand the types of trading strategies and the plays that you're using within the context of the market, that's when you're going to do really well as a trader. It's not about finding the magic trade and trading it non-subjectively, closing your eyes and hoping that it wins. It's about understanding the trading strategies, and not just the trading strategy, but the components within the trading strategy, your entry strategy, your exit strategy, your adjustment strategy, and understanding how to apply those appropriately within the context of the marketplace. So with Market Outlook, our purpose here is to help you understand the context of the playing field. And you'll find that if you were to join the Market Outlook, you have access to hundreds of market videos where we teach lessons every single cycle and with live demonstrations real time as they're happening. And you'll find that we can and we do have a very good context or a very good idea of what the market is doing. We have a very good understanding of the market pretty much at all times. And we can understand, what's most likely to happen over the coming week. And we can also understand what might happen in the market that's going to change those and how they change. And then we can, if we understand our positioning, we can apply that to our positioning, and we can make out much, much, much better as a trader. We can trade with much less risk. And, as we develop into our trading with the pros and trading to win series, we can create situations where we have very little relative risk, we have very high relative rewards and very high probabilities, given not just the trading structure, but given what's going on in the actual marketplace, which is where I would suggest that if you want to improve as a trader, where you should focus on. Okay, so with that said, just talk about our disclaimer here. This is given for educational purposes only. We're not broker-dealer or financial advisors, not making any specific trade recommendations. Also, please be aware that your risk in trading options and trading in general is substantial, and make sure that you're aware of all your risks prior to placing any trades. And also note that if we cover any trades in the webinar, please consider them to be hypothetical computer simulated trades, and results they do believe to be as accurately represented as possible. Keep in mind, live results can vary from simulated results for many different reasons. You can ask questions with Market Outlook. So if anybody has any questions, you can put that into the chat. There were no questions that were posted ahead of time, so we'll just move on. Also, a quick note, memberships are now open. So if you are interested in joining with us and you find that Market Outlook is going to be helpful to you with your trading, you can join that membership. And we also have many other memberships that will help you as a trader. So let's move forward here. For those of you who are new, one of the things that I attempt to do every week is we take a look at what the implied volatility, implied moves are for the Monday and for the following week. And this is where they come out. We like to compare those to where our technical levels are to see where they make sense. One of the things that you'll find, or one of the things that you're relying on a lot of times if you're doing like non-subjective trading, is things like delta numbers and so forth. Those delta numbers come from someplace, and they come from the extrinsic value that's in the options that you're playing. And so that extrinsic value comes from the feared move or the expected move in the marketplace, right? So everything all keys together, the expected move, and how do these market makers and people who are buying and selling options, how do they determine expected move? Well, the market makers will do it based on the buying pressure and selling pressure within the options, and the buying pressure and the selling pressure in the options is what determines the expected move. And why would there be buying or selling pressure on the options? Well, it's because there's technical levels. And you'll find out that they often key in with technical levels, and you'll see that today. We'll talk about that as we go along. And we'll also talk about this breakdown and how an educated person in the market is going to have a good idea of what's going on within the marketplace, because this is a very classic breakdown. So I just kind of want to break this down a little bit. So these are the expected levels. The weekly levels are the wider levels. The daily levels are the shorter levels. Again, we can certainly exceed these levels, but this is what the implied volatility market's pricing in as of end of day Friday. And then we have two lines, the expected levels. One of these is a point-based. So what'll happen is you'll come in here on, say, Friday after the close. We can look at our trade grid, and we'll have the asset price, and we'll have a plus or minus number. Again, once the market opens or once the futures open back up again, these numbers change around. You kind of want to catch it ideally before then, but there's also information available catching it afterwards, which we're not going to talk about today. That's a deeper concept, but basically we're going to come in here after close of the futures on Friday, take a look at our asset price, take a look at this here. This gives us our point value. So for the day coming in on Monday, there was plus or minus 30 points. It was actually bigger than that or different than that earlier before the futures open, but we'll just call this valid. So we'll say 54.59 plus or minus 30.62 is going to be our expected move for the day. That's one way to determine it. Another way to determine it is using a 16 delta option. We come in here and say, well, which option 16 delta? And expected move for the day, if we're looking at it here, it's going to be between 54.35 and 54.40. If we estimate that it's kind of in the center of that, we can say it's 54.37.50. And then you can do the same thing on the call side, and that gives you the expected move for the calls. And that is going to be what these lines represent, is what they were last Friday. Okay. And that way you have an idea of what the implied volatility market expects. And I like to compare that in with technical levels. So if we were to take this in isolation, our upper weekly level is actually coming in line with a head and shoulders breakdown pattern, which would be a retest of a head and shoulders pattern. And the downside, if you were to take a look at that, bring us in right here with a support level in the marketplace. And again, that's how the implied volatility market tends to determine how much they are expecting the market to move. Okay. When we break these levels, of course, that is going to be a surprise to the implied volatility market. A surprise from the implied volatility market is going to create an implied volatility shift, which is how we start looking at, if we're trading option structures, implied volatility can be important. I mean, it's not too important if you're just doing verticals, but if you start doing butterflies, broken wing butterflies, condors, calendars, diagonals, that starts to become important, because basically the flatter the flatter your T+0 line is, the more implied volatility sensitive you are. So that's the other thing that traders should understand that are doing complex options positions, right? And this is a general statement. It's not specific to all positions, but in general, the more delta you're allowing in your position, like in other words, if I'm allowing a lot of positive delta, a lot of negative delta, the less sensitive I tend to be to implied volatility. The flatter I try and put my position, in other words, if I start to try and protect my position by a price movement, by maintaining a very flat delta line, the more important or the more problematic or maybe beneficial implied volatility is going to be depending on how it moves. So in one context, I am making some sort of I hate to use the word prediction, but assumption on price movement. And the other context, I'm making some sort of assumption on implied volatility. And the problem is implied volatility for a large part is news and price movement dependent. And it's more complex to get an understanding of what implied volatility is likely to do than it is to get an idea of what price movement is going to. In other words, if I was going to go use the word prediction, I'd say predicting price movement is a heck of a lot easier a lot of times than predicting implied volatility movement. Yet a lot of people go away from directional trading and they go towards flat delta trading, which is actually more complicated to predict than the other, right? So meaning that a lot of these traders or a lot of traders who do that are less understanding of the playing field than someone who's playing a directional move. So we want to keep that in mind as well. So here, if we look at this, our implied volatility we talked about is predicting or they're planning for, I should say, that's probably more an appropriate word, is planning for a move up to retest the backside of our head and shoulders breakdown trend line on the SPX. Or if you're taking a look at to the downside, they have a support level. We have to consider that any movement within this area a very high probability situation. And the way this generally plays out is that if the market runs up into testing the backside of this first, we're probably going to get a negative reaction off of that. And that negative reaction is probably going to bring us back down into here. And that's going to be a completion of what's going on in the market or that pattern. And the longer term trend cycle is likely to take over, which in this case is up. Okay. So if I'm looking at this, I'm looking at this in the context of, oh, look, we set in a head and shoulders topping pattern. We confirm the topping pattern. The price pattern target on our topping pattern is actually here. That is actually in line with the implied volatility expected move. It's actually in line with our more primary support level, which is here. I have to favor, or if I look at this bounce initially, first of all, I'm very much expecting a bounce here. This area was, for those of you who haven't been joining us, this area here, if you look at the charts on various, like we switch back and forth between the current and the last, but if you look there's a lot of charts you'll see this area marked out in. This is an important area. When we came down into that area, we were expecting a bounce. In other words, if you played a bullish trade on Friday, that was a very high probability short-term bullish trade. This bounce would be or should be favor, right? So your probability should favor this bounce is a dead cat bounce, where we come in, we retest the backside of our trend line, and then we back down and probably go lower to price pattern target. That would be the most probable move, right? So our most probable move from here is either to come back down and just swing low and retest here, or bounce up into here and then swing back down and try and retest here. That's the most probable move that is likely to play out in the market over the week. The implied volatility market is not expecting a break here. If we do get a break back up, and I would put that level here on our swing high. So if I break this right shoulder on my head and shoulders, that's a failure of a head and shoulders pattern, and that switches us to extremely bullish. So one of the things that we should talk about, or that you should have an understanding of, is yes, we have these price patterns, but when they fail, we switch direction, and we switch direction hard on the probabilities of where the market's going to go. So as of the information we have right now, we have to expect there's a very high probability. Now, how you want to play this positionally is different, right? So we don't talk about this on this particular webinar. We talk about that in Trading with the Pros. We talk about that in Trading to Win. But how you want to play that's a different story. But right now, again, the probabilities favor that we're going to trade in this range, and that if we get a bounce here, it's going to come back down and probably either retest this bottom and then go higher, or retest here and then go higher. Again, we want to keep our longer term trend in mind. Any down move we get is bullish. We should have been playing this, this level bullish. If we get down to this here, we should play this level bullish. This level here, realistically, we should bounce back off of it the first time we hit it. But I expect it to ultimately resolve to the upside. I expect this pattern, again, being a shorter term pattern, to ultimately fail, and that we're going to go higher, and we're going to break swing highs, and the market's going to go higher. That's the ultimate outcome that I'm thinking, right? So if I'm thinking on the longer term, those are my thoughts. Again, new information may come into the marketplace. It may change that. For example, if we get a sharp break of this level here, then that's a failure of that pattern. We have another support level here at 52.30. If that fails, again, we can talk about the levels on the way down that we're going to do if that happens. And again, we've talked about that on other meetings. But I want to focus this meeting on understanding this pattern. We should get a bounce to the backside of trend line. We should get a negative reaction off that bounce. If we just clear this, especially if we clear the shoulder, that's extremely bullish. We have to flip our position and expect new all-time highs. Okay, if this plays out in the highest probability manner for the week, the implied volatility market, and right now I'm expecting this to try and test this area here or this area here and stay in that range for the week. And I would position my options positions accordingly. And then if we get that big break, then we want to switch our posture to bullish. So how might this play out in an options position? Well, if I'm here and I see this breakdown, again, first of all, this breakdown is important and it's valid, and I might want to switch my position intraday, which if you look at our standard Go membership, we don't generally trade intraday, but when I see the break of this area, in combination with some of the stuff I'm going to talk about, I want to switch my position bearish. I want to be maybe positioned a little bit neutral or bullish here to wait to see what's going to happen. I'd be positioned bullish, definitely if we get down to this level, or if we break the swing high, I definitely switch bullish. So if I made a down adjustment here to accommodate for my larger price movement, I would switch out of that, not when my delta gets to its maximum negative number. I'd switch out of that when I get a pattern break to the upside. So I'm switching more intelligently, more quickly than using a delta number when we start looking at this. Seeing this coming. If we go to our shorter term charts, what we had here is we had an uptrend in place. We had a price pattern, a cup price pattern that broke, right, cup and handle right here, that tried to break higher. We had another price pattern that tried to break higher. We had a failure of that pattern, right? So with this move back here, and this is as early as last Tuesday, like a lot of people got nailed on this move. Oh, no, I'm sorry. I think they got nailed on this move here. This was the big day, down day. A lot of people got nailed on this move here, but the reality is we can see it coming. And this is the biggest point. Like, understanding the context of the marketplace is going to be the biggest advantage that you can have in your trading. So I come into here, and again, this is a short-term chart, so they can get a little bit dirty. I'm not overly concerned about this candle from an intraday basis, right? Because my day closed higher. So I come in here, I get this pattern in that day, and we broke higher. That's bullish. I get in another price pattern. I held bottom. This is another bullish pattern setting up. I came up in here, and that's also, it's not bearish, right? It's a little bit bullish. I get this failure here on this day here on Tuesday, that's not good, right? I get it. And again, these are my shorter term charts, so I have to keep those within context. But I come in here and I get a double failure of a very bullish pattern right here. I broke a trend line and I closed the day under the low, right? So this is a classic short trade. I come in here, I have this double failure. I come in here, I retest, and then I break the low. This is a classic short trade. So if I'm understanding my playing field and I'm in a positive delta position, I have to really think about how I want to deal with that now, because this is telling me that the market's going down, right? Where's it going down to? Oh, that's an interesting question, right? So it's going down to, the highest probability is it's going down to here. Oh, wait a minute. That's a failure of another level, right? So if I come in here and this comes down into here and then it bounces, and by the way, right? So normal bearish behavior, I break down, I retest, I go down. I broke a more important level here. Normal behavior is I go down to a certain level, I come back, I retest, and I go down, right? Oh, this is setting up a head and shoulders pattern on my longer term chart. This is a failure of that level. This is, if I'm bullish, this is bad, right? The market's going down. It's very, very clear that the charting and the price patterns and the movement is telling me that all my bullish behavior is getting invalidated and my market is going down. And this is validating that my market's going down. And then I break my head and shoulders pattern on my daily part. Oh, the market's going down. What's it going down? It's going down to here. Now, at minimum, it's going down to here, and I'm probably going to get a bounce. And you can see that came into play, right? We came into here, we hit this level, we get a bounce. This is a short term. I mean, again, if new information comes in the marketplace that invalidates that's fine. But this is bearish, and this implies that I'm going to get a dead cat bounce here off the market. I didn't even reach my my important level, which is here. Then we back down. And again, this is just a consolidation pattern, and this may break one way or the other. You know, realistically, we shouldn't break over this level, but this head and shoulders pattern area is my important level here. A move all the way up into here is not bullish, by the way. A move all in here is still bearish. I would expect probably a push down from that. Again, if I get a breakdown of here, I have a price pattern to the downside that is likely to play out. And that puts us down into here, which is actually below our level, which is kind of interesting. But remember, we talk about our long-term charts are always more valid than our short-term charts. We talked about this a little bit earlier today. Our overall trend is up. We run into our overall uptrend down in here. And this is where I would expect a real reversal to come into place in the marketplace, where we're likely to get a switch to the high. But my point being is, you know, I might be bullish here, bullish. I want to understand when that context of that changes. It changes here. So from here, I'm watching my downside on the SPX. And I'm watching my downside because now I have a fairly high probability that this pattern is going to break to the downside. And when I do, that's a change in sentiment in the marketplace, and that's going to be a big move. And that is what we experienced last week. We experienced that 100-point move, or 100-point plus move down in the SPX on this day here. If we back out to get a context on a bigger term time frame, this is what we're playing with, right? We could see it in the hourlies as soon as here that the trend was breaking. It confirmed itself in the dailies here. And then, of course, we can go to the weeklies and we can talk about the weeklies, our weekly price pattern, our weekly support levels, like right into here, right? So a lot of times when you get failures in the short-term charts, this is where the price movement comes in conflict with our longer-term time frame. And this is where we would want to be bullishly postured as well. Then you can see how that correlates with everything else. Okay, so that's just about understanding the market, understanding where it's going. You know, for this week, the highest probability move for the week is to maintain. This gets kind of messy, and I'm going to want to clear it up, and I will do that for next week. But our highest probability price movement is basically within the levels. And I would say retest backside of trend line. And if we go break this level here, I would tend to be bullish over in this level here. And where's the information come into play is if we break this swing high. That is very bullish. And this swing high is doomed, essentially. I mean, like I said, we don't know for sure always where the market's going, but that move there would say that there's a very low probability this swing high is going to hold this resistance and we're going to go higher in the market. Okay, on the SPX. So that's how that's playing out. If we take a look and we compare this to what we like to do is compare it to our the other indexes. If we compare this with the movement going on in the NDX, now I don't do the levels on the NDX, but you could do it, and some of our students do it. I'm just going to look at the NDX technically. So I look at NDX from a technical standpoint. We will do something called cross-index analysis. So with the NDX, we can see something similar happening, right? We can see coming into this range here, we can see a price pattern come into play here. We can see a hit of that price pattern. It's not surprising to get a reversal off of that. We get a reversal. This is going to break, right? This is a very bearish candle pattern, first of all. If we look at short-term charts, that's going to break some sort of a short-term pattern. So if I come into here, I can see this set up, right? This is bullish. This is a bullish breakout. This is a failure of a bullish breakout. Oh, that's concerning, right? Failure of a bullish breakout takes us down into our primary support area. We set in a cup that cannot meet the new highs, right? And then we get a breakdown of this area and we break down our more important support. That's very bearish in the short term. And my point being, we're seeing the same breakdown in the NDX as we are in the SPX. We try and set in a bullish pattern. We get a failure of that pattern. Bearish, 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 right? Comes in conflict with our longer term time frames starting right here. So if we see this pattern and a breakout here, this is going to be a support level in the market. This is the same type of setup we have in SPX, by the way, right? So we have a support level here in the marketplace. Our more primary support is lower. Okay, so this is a shorter term support area. It's not surprising to see a short term bounce off of this, as in last Friday. Again, we may get a bounce into this area here, and this would be a level that what I would call a companion level with the head and shoulders level in the SPX. So a move up to there would be fairly normal. A move down to our more primary support level here would be normal. So we have to consider that a very high probability move for the week and how we position for that, that's a different story. That's going to be considered a very high probability move for the week. A breakdown to this area is pretty serious, implying we're coming all the way back down into here. So a lot of times what can happen is we can see certain things happen in one index that precedes what might happen in the other index. So for example, if the SPX breaks its head and shoulders level, and that is probably going to imply that this has a higher probability of breaking this level and reversing higher. If both of these break above this level, in other words, the SPX breaks above its head and shoulders level and the NDX breaks above its primary new resistance level here, again, that's very, very bullish. That would be a pattern failure. So with this here, we put in a topping pattern right here on the NDX. We had a breakdown of that on 725. That implies a move to price pattern target down into here. That we're probably going to get some sort of a bounce or a stall here, but that's going to be most likely high probability dead cat bounce, and we're probably going to swing back down low and come back down into here, right? So that's how I would play that. And then if I get a failure of that, then I start taking the move seriously. So that is what's going on in the NDX. It's pretty much in line with what's going on here. If we look at the Dow, we also get a breakout. So this is a normal bullish behavior, by the way. So we're looking at two indexes that are showing more bearish behavior. This is more normal bullish behavior. I get a breakout, I come back, I retest the breakout area, and then I bounce the breakout area. Bullish, 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 right? So our primary assumption here in isolation is this bounces and we come back high here, we break swing high, we continue to go higher. So this would not be considered a dead cat bounce. So we're getting a little bit of divergences in the indexes and how they're behaving a little bit. But if the SPX and NDX drop back down to the support level, what does that mean for this level here? It's probably going to retest down here again. So, we'll likely get maybe a bit of an up move here and then a pullback, retest again, and then move higher. I get a failure here, right? So this is my lead index right now, as far as breakout, what we looked at so far. The Russell may take that place a little bit later on, which it will. But out of the three indexes we looked at, this is so far the lead index, and this is the bullish behaving index. If this turns and flips on us to bearish, that favors the probability of the other ones going down. If this holds its bullish posture as the other indexes reset, that favors the market going back up. Okay, so that's how we kind of compare the indexes back and forth. But this is what we're looking like here. What probably will happen is if the other indexes retest the resistance level, this will test this high. This will back down off of the high, setting in a probably bullish cup and pattern handle, or it will cycle, setting in a sideways range, and then when everything else breaks higher, this is likely to break higher. If this fails, that's an early indicator that everything else is probably going to fail. And then we have our friend the Russell here, which I like to do last, and I get commented on this a little bit, but I like to do last because Russell tends to be the most volatile index when it comes to its levels. And I like to see what the other indexes are doing before I look at the Russell, because it gives me a better context of what's going on in the Russell. In other words, I'm looking at what I'm trading last, because when I look at the patterns in the Russell, I want to take them in context with what's going on everywhere else. So when I look at the Russell here, again, this was a fairly predictable move on the Russell. We had a very long-term sideways range. We had a very strong resistance level that had set up a long-term resistance level. When those break, they break really, really hard. And that was witnessed here. We got a very big move in the Russell. Like if we look at the weeklies, let's just look at this three-way weekly. I'll look at the default chart quickly here. This was a very strong resistance, back out, level that had set up in the Russell. That said, you can see this on our charts. You can see that this was highest for a long time. And I should probably widen this zone when we look at this, just for demonstrations purposes today. Right, I'm taking this into include swing highs. So what happened in the Russell is it came in and this is our high level, right? We broke our high level, we went down to our low level. So this is kind of like the pivot area or the decision area on the Russell of how it's trading. I came in, this decision area wasn't available here, but this is where it's set up. We came in here and we have this area here, that low, 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 right? So we're playing this low range for almost well over a year, and we break into the high range, and now we're kind of playing the high range, playing the high range, playing the high range. Within that high range, we set up essentially a head and shoulders type of pattern going on, and we're holding the high range for a period of time. So see how it held the high range and broke down. Now it's holding the high range, and again, the context of the market is bullish. It's time. It's for to the upside. This is a classic setup for a range break, right? So we're holding high range, holding high range, holding high range. On the weekly, we have a head and shoulders pattern that is setting up here. This move over that is very bullish and very high probability that this range is going to finally break. When that range finally breaks, it goes. If I do a price pattern target on this head and shoulders price pattern, by the way, do you know where it comes out? and you guys can do the math on this, and I do that now, it comes out exactly right here. I know a lot of you guys played this short off of this counter trend or this counter move really well. Hit the very top and went bearish here. Again, that's a very short-term trade that should be taken because the context is bullish and it's likely going higher. But this was a good call for a short-term reversal on that for you guys who made that. So congratulations on that one. But anyway, right, this is very bullish. So when I'm trading in here, I'm taking this day move very seriously. When we get this move up over this level, even though I'm at a fairly substantial resistance level, I have to take this very seriously because my patterns are telling me that this is going up in the short term, and it's about time that this level breaks, right? Because all levels break at some point, and this is clearly showing me that this is likely to happen, right? So in my longer term charts, I basically have a cup pattern and I have a very long handle, and that handle is finally showing that it's going to break higher. So let's just go back to our daily range drawings here. We got a big move down in the SPX, but the Russell did what we would call it held high, right? And that would be expected. So this is how cross-index analysis works. Like, you know, people will look at two indexes and say they're doing different things, but the reality is no, they're not. They both have their support and resistance levels that apply to each other. And within the context of those support and resistance levels and trends, they're actually doing something that really makes sense. If you take a look at this and you compare these, they're actually doing something that makes a lot of sense. So what's happening here is I got that breakout. The whole market came into their high levels. We got our failures on the SPX, and this didn't fail, right? This is still extremely bullish. This is more bullish than all the other indexes right now. We got a pullback in the index, which is basically just a settlement at a price pattern target. So again, if I did a price pattern target off of this pattern, it puts us almost exactly here. We backed off of that while the other assets had some short-term pattern failures. And the other assets have their support levels. So if we were to correlate this, if the SPX runs down, the Russell might run down and retest this swing low down in here. And the implied volatility market is kind of expecting that. They're kind of expecting that if the other assets pull down, this is going to retest these lows. They don't think it's going to break these lows. So this is, again, a bullish pattern setting up. Even if we come back down into here, I'm still looking for the market or the Russell to go up here. If the other assets break higher, this will probably just break higher and then just retest at a lot higher level. But my expected move for the Russell is that this very high probability that we stay within this pattern if we get a down move. And then if we get an up move, it's very likely we're going to come up into this range here. Probably up into here. So if I go into back into our 3 years, we have an important level. Basically, let me go 5 years. Need more time. If I go further here, this is an important range. Like how everybody should kind of see this. Let me do this with a rectangle. This is an important zone right in here. I'm going this swing high, this breakout and failure. This is an important level or previous level on the asset that's important. Where the markets move now, there's an extremely high probability that we're going to see this level in the Russell. Like if I'm short verticals here and they're longer term, I don't like that, right? Because this is an extremely high probability move that we're going to see that. Where we go from there, well, we may get a negative reaction off of that. We'll have to see what the other indexes are doing. But ultimately, this asset is setting up for new all-time highs. And I do believe we're going to see new all-time highs in the Russell. Probably not this week. The implied volatility market's not pricing in, but probably at some point before the election. We'll see that unless the overall environment of the election, right? So we're in a very news sensitive cycle right now. So we want to keep that in mind, and bad news can break patterns. And if we start breaking patterns to the downside, that's game-changing information. But with the information we have now, this is just a consolidation to consolidate this move, and it's setting up for a move higher, at least to here. And like I said, I do think this here is an extremely high probability move, in my opinion, and new all-time highs are high probability. Not extremely high probability, but high probability. And the reason I say that is because realistically, longer term, some of the other indexes are overextended, and we're coming into a very significant news cycle very shortly. Okay. But that's my thoughts basically on the Russell as well. And we're in a consolidation and we break higher. All right. And a couple of other things we usually look at, I'm not going to get too involved with today because we're over time and I have to get ready for our options trading for income information. Let's see, questions. Russell basically hit a mid from prior range a couple of years ago. Yeah, we hit the middle of a prior range a couple of years ago too. So there's different ways that you can look at this. And one of the things that I try to do within the context of the market outlook is I look at the market from the context of a lot of different traders. Long-term traders, short-term traders, traders that trade moving averages, traders that trade price patterns, traders that trade things like volatility cones, which is mentioned, or Bollinger Bands, and other types of indicators. And basically, when we talk about technical analysis, the more people that see a level, the more important it is. Like if I'm sitting in here and I'm trying to find out, and I'm trying to determine if this is an important level or not, and I'm using some special trick to see if it's an important level, it's not an important level because a wide range of traders aren't seeing it. When my short-term traders are seeing it, my long-term traders are seeing it, my Bollinger Band traders are seeing it, my Fibonacci traders are seeing it, my trend line traders are seeing it, and my price pattern traders are seeing it, that's an important level, right? That's a level that's very important. And like this level right here in the rut was an extremely important level. The break of that level is very significant, right? Now I saw it a lot earlier. Like I can see it building here because I'm kind of, again, I have an understanding of the playing field, but so I can see the subtleties, and it's good to be able to see those, but it's also the most important levels are going to be the levels that everybody sees. The next question is, do I use the probability cone study or the Bollinger Bands in my analysis? I do not use them. Again, there's no problem with looking at them, and everybody's going to use or have their own methods of doing this, and I'm not implying that my method is the only method. Again, Bollinger Bands, I don't even know how to pronounce that properly, probably, and probability cones, you can certainly use those. I don't pay any attention to them personally. There's also VWAP a lot of our students use, and we talk about sometimes in Market Outlook, like we'll go through cycles and we'll talk about different types of indicators, such as VWAP and using market internals and all that other stuff. There's lessons on that within the recordings. It's not something that I use every day, right? So you have to limit the context of what you look at. And I can tell you one thing, when we start talking about indicators and so forth, there is no magic indicator. And that's the problem with people with technical analysis. They're trying to create a magic indicator and they say, I can't create one. Well, yeah, no, right? That's the world we live in. You're going to be able to tell a lot more if you just understand price movement. And I can tell you my best performing technical analysis mentor and the best trading or the highest profitable traders that I know do not use any indicators. They don't use moving averages. They don't use any of this stuff. They just look at price movement. They look at the energy building up in the price movement themselves based on looking at the pricing itself. And they're just using price movement. They don't use any indicator whatsoever. Again, I'm not in that camp. I do have, I don't usually use much for indicators. I don't usually use Wilders either. I don't know why this is on this particular drawing. I do use average true range. Actually, yeah, this is average true range. So I do use average true range. I do like to be aware of what that is. I like to use or be aware of where the moving averages are. And I like to be aware of where my trend lines and price patterns are. That's what I tend to use. But a lot of times I'm primarily on price patterns. I do not have much use for probability cones or Bollinger Bands personally. I'm not criticizing those who do use them. It's just, like I said, everybody has their own things, and whatever helps you understand the market. Just don't use too many indicators. Don't use too many of those types of things, because you'll just get confused, and we don't want that. Okay, so with that, I just want to. I don't have much time. We can quickly look at the RVX. I'm very bullish technically. I'm very bullish with patterns, but this is a concern. Implied volatility has been rising quite a bit in the market. So I'm getting. So one of the things I tend to do is I take a look at the implied volatility. I don't use that to determine where I think the market's going, but I do use that to help assess probabilities. And I don't like what the IV market's doing in contrast, because it's kind of it's running in contrast to what the actual price action's doing, and I don't like that. Right, so it's going to cause me to lower my conviction level on my price analysis a little bit. And then I also have VIX, and it's kind of the same thing. I'm not really well. This is not really concerning with the SPX, because the SPX is going down. Right, it's going down a lot, and there's some fear in the SPX. This is kind of normal given the price movement, and that doesn't really bother me. The RVX is a bit of a concern for me. I don't like how high that is. Although I also have to keep in mind that when we get very large moves, even if they're up moves, I'll often get an increase in RVX, simply because I have an increase in long call buying and so forth, right? Or possibly long puts. Keeping in mind that if you buy, if I say people are buying long puts, there's also somebody selling them. There is no buying an option without somebody selling an option. But the pressure on the options is buying them rather than selling them, is what we need. And then just a quick look at horizontal skew curves. So over the last week, so one of the things we look at sometimes is implied volatility. Our typical behavior for this is horizontal skew curve. Our typical behavior is week over week, we get a drop in implied volatility, and we go more into contango. We got the opposite of that last week. We got a rise in implied volatility and a move out of contango. So that tends to be bearish, but again, it's not surprising given the extent of down move we got in the SPX. As a matter of fact, with the extent of that, with that 100-point down move in the SPX, you would expect the market to go into backwardation and to get a large IV increase. And the fact that we didn't go into backwardation and we didn't get a large IV increase relative to the size of the move. So this is we have to compare that, right? That's relevant. We didn't get a very large one, so I don't think the implied volatility market's actually taking that all that seriously. But there is a lot of concern coming with the election. You can see it right here, right? So and we've been tracking this for over a year now, right? So, but anyway, that's what's going on here. There's really nothing counter here, but it's not as confirming as I'd like. And with that, I'm going to let you guys go. I have to get ready for my next meeting. Thank you for joining us for the Market Outlook. We hope you consider joining the Market Outlook membership so that you can understand the playing field in which you're playing, and then help you make better trading decisions on your, whether you trade market neutral or directional. It'll help you make better trading decisions. And of course, if you make better trading decisions, you get better results. All right. Thanks for joining me, everybody. We'll see you guys the next time. Trade well.